Welcome to Chapter 21, where we will discuss accounting changes and error analysis. Our first learning objective is to identify and differentiate among the types of accounting changes and explain how to account for them. Why do changes occur? The accounting profession may mandate new accounting standards from time to time, and changing economic conditions may cause a company to revise its methods of accounting. Changes in technology and in operations may require a company to revise estimates of decision pattern or accounting estimates like assets, residual lives, or service lives, depreciation patterns, etc. And corrections are also needed when accounting errors are identified. Those are our least favorite. The overall objectives of accounting and disclosure are to limit the types of changes that are permitted, standardize the accounting for changes, and ensure that readers have the necessary information to understand the impact of the change on the financial statements. We're really concerned here with reliability and consistency. And so we're weighing out those two concepts. Consistency would say never change your accounting policies or revise any of your estimates or maybe even correct errors. That's arguable. And on the other hand, reliability says that the best information that we have is what we should be using to set our estimates. So we're really balancing between those two things. And we want to make sure that the readers of the financial statements understand the decisions that management are making. So there's three types of accounting changes, and these are agreed both with IFRS and ASPE. So there's a change in accounting policy, which means that it's a change in the choice of a specific principle or a rule or practice applied by an entity in presenting the financial statements. So an example would be initial adoption of a new standard or a change in an inventory cost formula. And in order to have a change in accounting policy, it needs to provide reliable and relevant information. There's also a change in accounting estimate, and this is an adjustment to the carrying amount of an asset or a liability, or the amount of an asset's periodic consumption or depreciation, and like the service life of an asset or the realizable value of accounts receivable are two examples. And the third type of an accounting change is the correction of a prior period error. So this is an omission or a mistake in the financial statements of one or more periods caused by a misuse of reliable or accurate information. And this can be intentional or an oversight, it doesn't matter. And an example would be a failure or a mistake forgetting to record depreciation on capital assets. So there are a variety of choices of accounting policies. So companies can choose their accounting policies consistent with the conceptual framework and specific guidance in ASPE and IFRS. And under both IFRS and ASPE, there may be a few different accounting policies that could be chosen. An example is depreciation. If you remember in 3110, we looked at lots of different depreciation methods and the company could choose which method that they wanted to use. Now, what happens if they've chosen one and now they want to change to another one? That's the question that we're answering in this chapter, sorry. So what conditions must exist for an entity to be allowed to change its policy? So one of two conditions is required. Either the change is required by GAAP, IFRS, or ASPE, according to whatever the company reports under, or the voluntary change results in presenting reliable and more relevant information. ASPE also allows a voluntary change between or among ASPE methods of accounting. So there's a few different ways that companies have a little bit more leeway in terms of changing their accounting policy under ASPE. And you can do this even if you don't meet the reliable and more relevant criteria. But generally speaking, it's easier just to remember it needs to be reliable and more relevant, and then a company can change its policy. Changes in accounting policies can also happen when new standards come out, new accounting standards. Sometimes companies want to early adopt these policies, and the early adoption is not considered a voluntary change in policy. And changes from a policy that were not acceptable or incorrectly applied, so erroneous policies, are considered corrections of errors. And when an item is reclassified in the statements, so the actual numbers don't change, but an item is just moved between two lines, then we don't consider that a restatement. It's only a change in presentation. So we would just label it that way, and we wouldn't have to meet all the disclosure requirements that we're talking about in this chapter. In this chapter, we're actually talking about changing a number that's going to impact the bottom line, not just a movement between two numbers that has no impact on the bottom line. That's fine. Here we're talking about what happens if you're going to change your net income. So changes in accounting policies, again, is clearly not a change in policy if a different policy is applied to transactions, events, or conditions that are in substance different from those that occurred. So for instance, let's say that you don't have any technology assets right now, but right now you depreciate all your assets using straight line. But now that you're thinking about getting building some technology assets, you're thinking that you need to depreciate those, maybe using declining balance. That's not a change in policy because you don't have technology assets right now. So it's not the same thing. It's not apples to apples. And also if a different policy is applied to transactions or events that didn't occur previously. So in my first example, those were different in substance. In this example, it would be like something never happened before, some type of an expense that you've never had to account for before, then you wouldn't need to worry about having a consistent accounting policy, obviously. Now, future conditions and events and their effects cannot be known with certainty. So estimation is required in the financial statements. And it's normal to expect accounting estimates to change over time with new experience and additional information. Changes in estimates is achieved through assessing the present status and future expectations associated with assets and liabilities. And sometimes it's difficult to differentiate between a change in estimate or a change in accounting policy. So in cases where it's unclear or right on the line, we default to saying that it's a change in an estimate. Here are a few of the many examples of accounting items that require estimates. So the collectability of accounts receivable, the obsolescence of inventory, the fair value of assets and liabilities, warranty costs. We saw earlier in this course how hard it is to measure warranty costs. Companies are just guessing. And useful lives patterns or consumption and residual values of depreciable assets. Standards make a distinction between errors and changes in estimates. So estimates are approximations that change with experience and additional information. Errors are omissions or mistakes through oversight or intentional that are not discovered until the financial statements have been issued. To distinguish between the correction of an accounting error and a change in estimate, when a careful estimate later proves to be incorrect, that's a change in estimate. When the estimate was obviously calculated incorrectly or done in bad faith, that should be considered the correction of an error. So there's three ways that we can have been suggested for reporting changes. There's a retrospective application. The retrospective application is where we apply a new accounting policy in the accounts as if the new method had always been used. So the cumulative effect of the change at the beginning of the period is calculated and an adjustment is made to retained earnings. All prior years' financial statements are affected and restated consistent with the new policy. And the objective of this is consistency in financial reporting and comparability. That's why we restate prior years. There's a prospective application, which is where previous reported results remain, so no changes made to the previous year's net income, but the opening balances are not adjusted and no attempt is made to correct or change past periods. The new policy is applied to the balance existing at the date of the change, and the effects of the change is reported in current and future periods. So it's literally just prospective going forward, and retrospective is obviously looking back and trying to fix what went wrong. Even though those statements are issued, normally companies present 2 years of financial statements or 2 years of comparative information in their financial statements. So it's about restating that comparative column and also making sure that your opening retained earnings for the current year is correct, because it may require restatement. It will change when you change your income for the past years. So accounting standards for each type of accounting change indicate the only two ways that we can account for things are retrospective or prospective. And when new GAAP or new ASPE or IFRS standards are adopted, the recommendations in the standard usually tell companies how to handle the transition. So if it's going to be prospective or retrospective. Okay, so here's an overview of how we apply these different changes. So we said that there are three types of accounting changes. There's a change in accounting policy, there's a change in estimate, and there's the correction of an error. Okay, so if it's a change in accounting policy, we're going to correct it retrospectively. If it's a change in an accounting estimate, like, oh, I thought that I was going to have, 90% of my error being collectible, but it's only 50%, that's just a guess. That's prospective. So a policy is like saying, oh, I'm going to account for my inventory using FIFO, and now I'm going to use average cost. That we need to go back and correct everything so that it's at the same costing principle. Otherwise, if you're looking at 1 year of statements with FIFO and 1 year with average cost, you can't compare them. So that's why we're going to do the change in accounting policies retrospectively. It's the estimates, and estimates are really the most judgmental and uncertain, and you never know that your estimate's correct because it could be wrong the next year. It's always an estimate. Those are prospective, and the correction of an error is retrospective. So there's three changes: policy, retrospective; error, retrospective; estimate, prospective. That's really all that you need to know. Okay, so let's talk about retrospective restatement. So let's talk about how we would account for a change in an accounting policy or the correction of an error, because those are the two that we're going to need to account for retrospectively. Okay, so the underlying principle of the retrospective application method is that all comparative periods are presented as if the new accounting policy had always been used. So the retrospective application means that the opening balance of each affected component of equity is adjusted for the earliest prior period that is presented. And all other effective comparative amounts that are disclosed for each prior period that is provided are presented as if the new accounting policy had always been used. A limited version of retrospective application may be applied only if it's impractical or impossible to do restatements, but it's very difficult to meet this criteria. You have to say you can't determine the effect, you don't know what the assumptions were about why management did that, and that there are significant estimates that take into account circumstances that existed previously, but that can no longer be made. In most of the textbook questions, we're not looking at any sort of limited version of retrospective application. It's just retrospective or prospective. So let's take a look at an example. A company follows ASPE and has expensed all interest costs incurred on self-constructed assets since beginning its major capital upgrading project in 2018. In 2020, the company changes its accounting policy to one of capitalizing all avoidable interest costs related to the self-constructed assets. The company recognizes deferred and future taxes. The company is subject to a 30% tax rate. And they've also expensed interest for tax purposes and plan to continue using this method in the future for tax. Okay, so here's the information that we're given. So in the question, we're given all this information. So we're told that the income based on interest expense policy. So the first box there is what happened. The second box underneath it is what should have happened if they had followed the new policy that they want to adopt. And then along the side, we've run the differences between what the existing is and then what the desired state is. So as an example, income before income tax in 2020 when we were expensing interest was $133,000. Now, what we want to do is capitalize interest. So in 2020, then our net income would be $140,000. So you can see that in the very bottom corner, in the white section there for 2020, we've got that our income would go up by 10,000, and that then our income would go up by our net income would go up by 7,000, because you can see that obviously we were running the income before tax, the income tax, and then the net income lines as the comparatives. We've done that for each of the 3 years because we have to report a change in accounting policy retrospectively, which means we need to look at all the prior years that were given. So the first step is to make an accounting entry to recognize the effects of the new accounting policy along with the related income tax effects. So assuming the 2020 accounts have not been closed, the adjustments to 2020 income are made through the income statement, so we don't need to worry about hitting retained earnings for that. And changes to the prior years are made through retained earnings. So the below is our entry on January 1st, 2020. So what we're going to do is we need to capitalize the interest. So the total change to the income was, if we go back here, so we can see that our income increase in 2018 was 200,000. And the interest from 2018 and 2019, 220,000 is capitalized. So you can see that we've got these, if we look at this statement here, sorry. So the interest that we want to capitalize, which is the total of all the differences here. So you can see 200 in the white section are called differences. So the income 200 plus 200 plus 20,000 is our 220. And 2020 we're saying is still open, so we can adjust that through the current year. We don't need to worry about that right now. So that's how we got our 220. And then our deferred tax liability. So we have a taxable temporary difference on the fact that now we're writing back an asset onto our statement of financial position with $220,000. Remember that from chapter 18, a difference between the accounting value of an asset, the carrying value, and the undepreciated capital cost, or the UCC of tax, results in deferred tax liabilities or deferred tax assets. Now, if our future taxable income is going to be higher than our accounting income, that is bad for tax because we want to have lower taxable income because we want to pay less tax. So if our taxable income is going to be higher than our accounting income, then that creates a deferred tax liability. And because we're increasing the tax basis of the asset for accounting, and it's not increasing for tax because we were told that how we accounted for it for tax was fine. We're increasing our accounting value, our tax value is still where it was. Now, of course, if our accounting value is higher than our tax, we're going to have a deferred tax liability. And that's what we have there. So we've taken the 220,000 and we multiplied it by the 30% tax rate to get ourselves the deferred tax liability of 66,000. The other way you could have gotten that amount in this question is simply by adding up in the differences column on the far right-hand side, adding up the tax effect of each of the 3 years. That would have also gotten, or of the first 2 years, because 2020 we're dealing with in the current income statement, that would also have got you the 66,000. And then the sum of the two is going to go through, or the difference between the 220 and the 66 is going to go through our retained earnings. And it's important to note that retained earnings is the accumulated after-tax effect of the new policy up to the beginning of the current year, and it represents all changes to all prior years' income. So this entry on January 1st, 2020, and the revised policy is applied to the current year's operation. So in 2020, we're just going to apply everything prospectively, of course, but this is our entry to correct what happened in the past, because accounting policy changes are required to be recorded retrospectively. So step 2 is the financial statement amounts for prior periods that are included for comparative purposes are restated to give effect to the new policy. So you can see that in 2019 now, you can see that there's brackets there saying restated. And now this is our new 2019 income based on our new calculation. We also have to reconcile and include a line in our statement of retained earnings. And this must be under ASPE because that's the statement that we have under ASPE. IFRS has a statement of changes in equity. But either way, we have to make sure we have a line that specifically identifies the change in policy and the impact on opening retained earnings. So you can see in the bottom box there, it says opening balance as previously reported. So when we last reported retained earnings, we had 1.64 million. And then we have the change in the capitalization of interest policy. And then we have our opening balance as restated. So it's very clear to a reader that we had this retained earnings, we did this, now we have this opening, and then what's happened for the year, just as we normally would. So step 2, continued. Financial statement amounts for prior periods that are included for comparative purposes are restated, just as we just saw. And like I said, under IFRS, we would have the statement of changes in equity, and we would need to think about the impact on earnings per share for basic and diluted earnings per share, because IFRS is really focused on public companies. So public companies are what have earnings per share. That's why that's specific to IFRS. Private companies don't have shares that trade on public exchanges, so they're not going to have earnings per share. And step 3 is to prepare the disclosures so the users will understand the effects of any changes on the financial statements. So here is an example of a change in accounting policy, statement of changes in equity for under IFRS. So we saw this, the reconciliation of retained earnings, or the statement of retained earnings under ASPE, and this is what it would look like under IFRS. So you can see we've got the balance previously reported, the change in interest capitalization policy, and then our balance as restated, and then the same as before, what went on during the current year. Disclosures required for a change in accounting policy. So these disclosures are required in the period of the change, whether accounted for retrospectively or prospectively. So for the initial application of a standard or primary source, the title, the nature of the change, what and how transitional provisions were applied, the nature of any voluntary change and why it provides reliable and more relevant information, the effects of the change to the extent practicable on a line items affected in the current period and on periods before those presented, and if full retrospective application is impracticable, why and how it was handled. Under IFRS, we also need the disclosures when a transitional provision or voluntary change might affect future periods, and basically just disclose as much as possible. Retrospective restatement is also used in the case of an error correction. In the year in which the error is discovered, an adjustment is made to the beginning balance of retained earnings. Prior period statements are restated so they appear as if it's happened, and restatement is done in the first set of financial statements completed after the error is discovered. So our previous example, we walked through change in accounting policy. That's required to be recorded retrospectively. Now, the other thing that's required to be recorded retrospectively is the correction of an accounting error. That's what we're talking about here. It's super similar to how we would account for a change in accounting policy, so retrospective. So we're going to restate the prior period, restate the opening balances, and making sure, and only if it's impractical, then we have to do this partial restatement. Okay, so let's look at an example, another example here. So a company discovered in 2020 that in 2019, $20,000 depreciation on a newly constructed building was not recorded. The company follows ASPE and recognizes deferred taxes. The tax rate is 30%. The 2019 books have been closed. Assume unadjusted retained earnings on December 31st, 2019 were $350,000, and net income for 2020 was $400,000. So adjustments are required for, so we've got depreciation expense was understated by $20,000. Our accumulated depreciation was understated by $20,000 as well. Our deferred tax expense was overstated by $20,000 times 30%, or $6,000. Net income was overstated by the $20,000 minus the $6,000 tax expense, so $14,000. And our deferred tax liability was overstated by $6,000. Okay. So the journal entry to correct the error is going to be debit retained earnings. So, okay, so let's see. So let's start with debit deferred tax liability. So we're decreasing our tax liability because it was overstated. Remember, it's overstated, so we need to bring it down. So debiting a deferred tax liability decreases it. So we're going to decrease the deferred tax liability by $6,000. We're going to increase the accumulated depreciation on the building because that is understated by $20,000. So we need to increase the accumulated depreciation. And then the net of the two is going to go through retained earnings as a prior period adjustment. The retained earnings account is adjusted because all 2019 income statement accounts were closed at the end of that year. And here's our reconciliation of retained earnings. So you can see again, we've got as previously reported, 350,000, correction of an error depreciation, less income tax reduction. And then we've got our restated opening balance. We're going to add our net income and get to our ending retained earnings. And adjustments are made to correct the amounts of all affected accounts in the statements of periods that are reported. So you can see that we would have corrected our balance sheet and our income statement and our retained earnings. So this is just showing the net impact. Of course, we would show the full dollar values. It would just have these adjustments running through it. So this is just for simplicity, this illustration. We would never show it this way on an incremental basis. All right, here's one more example. So assume that when preparing the financial statements for the year ended December 31st, 2020, it was discovered that a property purchased in mid-2017 for $200,000 had been charged entirely to the land account in error. And of course, we know we don't depreciate land, so we haven't been depreciating this property either. So the $200,000 cost should have been allocated between land, which should have been $50,000, and the building should have been $150,000. The building was expected to be used for 20 years and then sold for $70,000. The company follows ASPE and recognizes future income taxes. So each analysis requires identifying two things. First, what is in the account now, and what would have been in the accounts had the error not occurred. And our adjusting entry, of course, reflects what should be there now. So our journal entry to correct this is going to be, so we know that if we go back here, we should have 150,000 in buildings. So we're going to go debit buildings for 150,000. Now we should have had depreciation expense for the building. So we are going to put on the current depreciation expense, which is going to be the 150,000 minus 70,000 residual value divided by 20 years is going to give us our depreciation expense of 4,000. Our deferred tax asset is going to be it should be the carrying value of the asset times the tax rate. So we have our building, we need our accumulated depreciation first. So the land, we're going to decrease the value of the land by the 150,000 that was overstated by. The accumulated depreciation on the building is going to be the past, how many years has the building been there? Mid-2017. So, and it's 2020, so say 3 years of depreciation and the current tax benefit. So let's take a look at the next slide and see what we've got. It looks like we had this information here too. So the question provided this information. So the depreciation expense each year is 4,000. So you can see how we got the current year's depreciation, which is what the depreciation expense is, and then the accumulated depreciation, which is 2019 to 2017. You can see that there's the tax benefit there that we need to decrease the 1,200. And you can see at the very bottom, there's the 4,200 of the deferred tax asset. So let's take a look at the explanation for these entries. So the first one, we move the 150,000 from the land to the building account. Makes perfect sense. 2, the 2020 books are still open. Depreciation expense for 2020 can be charged directly to the expense account, which makes sense. That's why we hit depreciation expense. The deferred tax asset is the deductible temporary difference between the tax basis of 150 and the carrying amount of 136. The effective income overstatement in years 2017 to 2019 is 10,000 of total depreciation minus the 30% related tax benefit of 7,000. And we're going to recognize the accumulated depreciation for the 4 years, which is how we got the 14,000. And the related tax benefit from the deductible temporary difference is charged directly to the accounts because the books have not been closed for 2020. We're going to restate the comparative income statement. So we're going to put those brackets in that say restated and restate all the amounts as if it was always stated that way. And we're going to restate our retained earnings. So here is our ASPE statement of retained earnings. So we've got retained earnings as previously reported, the cumulative effect of the accounting error, and we do disclose it net of tax, which is important. And we do disclose what the tax taken off of it is. Then we're going to have our retained earnings as restated opening, then net income, dividends declared, whatever was going on in that account, and our ending retained earnings. So disclosure required for the correction of an accounting error is we need to disclose the nature of the error, the amount of the correction made, and what periods it was made to. And IFRS also requires us to disclose the impact on basic and diluted shares, if there were any issues with getting the information we needed to correct the error, and we have to record the opening statement of changes in equity. And that concludes part 1. Please join me for the tutorial section where we're going to walk through quite a few more examples.